Which stakeholder of the finance function, 110, question number 110 on the screen. Which stakeholder of the finance function is most likely to require data on competitors' pricing strategies? Who would require? Which stakeholder of the finance function is most likely to require data on employee productivity? Productivity?
HR.
Which stakeholder of the finance function is most likely to require data on market trends? Data on market trends.
Production.
Sales. Sales.
That's right, that's right. Market, no? Market trends. Directors will be the stakeholder of the finance function most likely to require data visualization. Is this statement true or false? Data visualization, wherein it is okay, if they do not understand the data presented in a quantitative form, in that case they would require that. So the option what is given is we have to mention whether it is true or false. So data directors will be the stakeholder of the finance function most likely to require data visualization.
True.
Can we generalize as true and or false?
True.
Why? Visualization is if it cannot be easily understood, then presenting in a way that it can be made easy to understand. Now here we have these directors. Directors also may need, but it says that most likely to require. So that part of it, can we say that people at the director position definitely would have some knowledge about how to understand the accounting data? So it can be a possibility, but it's not most likely. They would have an overall view of every aspect of it. So the quantitative data also would be easy for them to understand and interpret. So in that case, we cannot say that it is most likely. So on that note, it becomes false. What are the three stages in transferring data in the correct order? Yesterday only we have learned about that. What was that? The slide.
Option C.
What's that? Okay, let's see. A data model considers the data of an organization in a systematic way that allows it to be stored and retrieved in an efficient and effective manner. Match the level of data modeling with its description. So we need to match them. Um, Conceptual, logical, physical. This level begins to develop a technical map of rules and data structures defining how data will be held and used. This considers how the defined system requirements will be implemented using a specific database management system. Business oriented and practical, considering the business data and its requirement. So we need to match them. What would be conceptual? It's when the designing part of it, or when the uh, concept framing part of it is there, they first take the requirements, expectations of whoever are the people. So that's when they design the concept. After that, then they put to test, and then they uh, physically, they start implementing it. When the requirements are taken, that becomes conceptual. Next, logical. What can be described as a coherent approach for organizing, governing, analyzing, and deploying an organization's information system? Where is the concept? we have done about data strategy, the strategy related to data, how data would be useful in the business. Where did I include that? I'm not able to identify. Data strategy. Data strategy planning. Huh. Yeah. Sorry. Data strategy is a coherent approach for organizing, governing, analyzing, and deploying an organization's information assets. So, on that note, we see here the answer would be data strategy, a coherent approach for organizing, governing, analyzing, and deploying an organization's information systems. After that, 117, what 117, what is the process of changing data to make it easier to read, describe, easier to read?
Data mining.
Manipulation. Mining we didn't study at all. So we didn't study mining. Manipulation. This can be made simple with the help of data manipulation language. So data manipulation is the answer. 118, which of the four V's of big data refers to the constant stream of data being produced? Constant stream of data being produced. Is it variety, veracity, volume, or velocity? See, variety talks about different types of data. That's not mentioned. Veracity talks about the genuinity of the data. Volume talks about the size. Streaming, constantly streaming is it is about continuous processing which is taking place. So that is the velocity at which this is being processed. So we take it as velocity. 119 says, what does the technology driven process of analyzing business data describe? So the answer is BI. Which of the following best describes an ETL system? ETL is extraction, transformation, and loading. See, the process of harvesting data from source locations, transformation of data into a suitable format, uploading of client data into a data warehouse, a single tool to automatically bring data sources into a destination system. What do you think is the right answer? Extraction, transformation, and loading. All three of them. Easy. Very logical it is there. Extraction is collecting the data from various sources, then processing that data. Then after that, it is stored in a single location. So D goes with that, no? So a single tool to automatically bring data extraction, and then after processing it, transforming it is loaded into the storage place. So it's in a destination place. The use of a dashboard to present data is an example of what? Dashboards are used in case of visualization, simplification, graphical data, information processing. Very general. Yesterday also I was talking about a cricket match where the analysis is present about how the players have played and then the ball went into which direction. All that is presented in a dashboard. So in one glance, everything can be understood. So that's about visualization. 122 says the need for systems to validate data links to which of the four V's of big data. Validation about the authentic data, the authenticity is validated or the genuinity of it is validated. So which we do we go with?
Option B, ma'am.
That's right, veracity. Good. Then 123 says technological advancements are constantly changing the skills and knowledge an organization requires in a finance professional. Which of the following skills will require the finance professionals to build empathy and interaction with stakeholders? So there are certain skills which are needed by the finance professionals. So out of those skills, which of them talk about building an empathy? Empathy, trying to understand and relate with the other individual is empathy. To build empathy and interactions with the stakeholders. So what type of skill? Is it digital scientist skills, leadership skills, technical skills, or people skills?
People skills.
That's right. 124. Interest cover, market value of non-current assets, and the amount of existing loans are all types of data of most interest to shareholders, directors, employees, lenders.
Lenders.
Why do you think so? Why do you think so? Because they are the ones interested to understand about um, whether they have the ability to pay it back. See, interest coverage ratio talks about how much profit is available to make the interest payment. That is interest coverage ratio. Market value of non-current assets and the amount of existing loans. So, what is their position in the long run? So, the long run assets, the fixed assets, and the long run liabilities. Uh, See, liabilities are a claim on assets. So, as many number of liabilities they have, that many number of assets should be there. So, if there are sufficient number of it, so there is, I mean, the claim can be made in times of insolvency or something like that. So, if they have sufficient number of assets to repay all the loans, even in situations where there's no profitability, if they go in for insolvency and all, so there should be sufficient number of all this is looked into by the lenders because they are the ones who have to take a decision about whether or not to extend the loan further. So that on that context they are interested. Others are not interested. Shareholders, uh, they are interested to look at the profitability. Directors also, the overall performance is looked into. Employees again, profitability only because their bonus is connected to that. Lenders are the ones who will look into their financial position. 125 says in relation to data, which of the following statements are true? One cannot have too much data, so an organization should gather as much as possible. As far as sales prices are concerned, a sales director just needs the average sales price achieved in the most recent reporting period to manage the business. Do you think any of them we can go with them as true? first one, too much data is not needed. How do we decide what is too much? See, all that which is useful for the organization has to be collected. Where do we draw the line? Where do we say that this is too much? So unless and until data or information is available, decisions cannot be taken. So on that context, we see that we cannot define that too much data is not needed. So A is not correct. One is not correct. Sorry. One is not correct. Two, the second alternative. As far as possible, the sales director is only bothered about sales price. It's not only the sales price. He has to understand about so many other aspects about it. It's not just the average sales price. Has to understand what's the demand present, what are the strategies adopted by the competitors, um, do they have to come out with new promotional techniques. So all those things are part of the concern of the sales director, isn't it? So second also will not be correct. So on that note, both of them are not correct is D. 126 says an effective data strategy should consist of 5 elements: identify, store, provision, process, and which other. We didn't discuss, but otherwise, in general, an effective data strategy should consist of 5 elements: identifying the data, processing the data, storing the data, have a provision um, to retrieve the data. What else? Is it responsibility, manage, govern, or congruence? In a general context, you just see that and then tell me. It is not data responsibility, it is not data manage, it is data governing. Whole congruence is about everybody thinking about the same aspect. That's congruence. 127 says which of the following is not a level in data modeling process. In the context of an ETL system, which of the following statements are true? Data is extracted, then profiled before being loaded into the data warehouse. Second one, once data is profiled, it is transformed to a suitable form before being extracted and loaded into the data warehouse. Which one of them is correct? Not answering. What is the meaning of profiled? Somebody answer. What's the meaning of profile? Anyone? Data is extracted and then profiled. See, first it is profiled, then it is extracted, then it is loaded into the data warehouse. Those are the steps. So, what's the meaning of profiled? See, whatever is the data which is required, that is decided upon that, then it has to be extracted. So, profiled or arranged, or I mean, the concept is arranged. The what has to be done is all described or defined. So profiling will take place first, then extraction takes place, the processing takes place, and then it is stored in the single destination place or a data warehouse. So one is not correct. Then we see what is two. Two says once data is profiled, it is transformed. So data itself is in the first stage, then the extraction. Once the extraction is done, then it is transformed. So second one is also wrong. So once the extraction takes place, then it is transformed to a suitable form before being extracted and loaded into the data warehouse. One 129 says ELC company has produced some infographics to enable the visualization of its sales data. Which three of the following characteristics will make the infographics more effective? Details of sales made to each customer on a daily basis, the ability to drill down to obtain further details, avoidance of technical jargon, access granted to all sales staff, intuitive visualization needing little explanation. So here we have to select three. Characteristics will make infographics more effective. What can we choose? A says details of sales made to each customer on a daily basis. Who would be interested to look into each customer every single day what sales are made? It is of no use and relevance to anyone to understand what's the sales on a daily basis. Then we have B. B says that the ability to drill down on to obtain further details. See, that is see when the summary is presented to the top management, it is just a summary, but there is a provision always which is included stating that Whenever they require additional information, that facility to drill down should be there. So when the summary is presented in a visualized format, if needed, other aspects also can be looked into. So the facility to drill down on the data should be there. The ability to drill down to obtain further details, the data visualization. Okay, that provision should be there. Avoidance of technical jargon, as it is simplified so that many can understand, because they are not able to understand, that is simplified. So once the data is all simplified, again using technical jargon will create some more issues about they not being able to understand that. Therefore, the technical jargon, the terminology, those things should be avoided. Avoidance of technical jargon. D says access granted to all sales staff. Intuitive visualizations needing little explanation. Access granted to all sales staff. Can we go with that? What is intuitive visualization? Intuitive, predicted or forecasted visualizations needing little explanation. So between the two of them, access granted to all sales staff not needed. Only those that require this information for decision making, if they are provided with that, that is sufficient. All of them may not be interested to know about what is happening, what is the summarized format, etc. So on that note, we cannot select access granted to all sales staff, but we go with the E, intuitive visualizations. Whenever they have the forecasting presented, such things need little explanation. In the world of big data and the role of accountants, which of the following statements are true? Although there is more data, the basic analysis techniques used should be the same, and so no upskilling is needed. Is it no upskilling is needed? Then experts may be needed to provide additional analysis of the data. Which of them are correct? First one, first bit. So can we say that no upskilling is needed? Can we go with one? Please answer. Can we go with one? Is one correct? One is not correct. Although there is more data, the basic analysis techniques used should be the same and no upskilling is needed. If that was the case, there would have been no concept of big data itself. See, if the basic analysis technique used should be the same, if that is the case, why another software to process this large volume of data? So there wouldn't have been any necessity. But here, the way in which the data is analyzed, um, there are special softwares like Hadoop and all used. So on that note, one will be disqualified. Is second correct? I don't even know whether you're there or not. B is the right answer. Nobody is responding only. Okay, chalo. We finished section D. The final thing, section E is only remaining. All the questions under section D are done. So we will be taking up questions from section E. But there's some more content which we have to finish in section E. Finance interacting with the organization. Yesterday we started with the interaction of finance with various functions. So that's the last topic what we have. But there are many departments with which finance interacts, the many other functions with which finance interacts. So yesterday we have started with the interaction of finance with operations, but that is also not completed. So let's first understand about what's the interaction of finance with operations. So we understood basically how the finance function relates to other functions. So first it provides whatever is the required information. Then they work with the other stakeholders to influence and shape. Then the CFO will work with the leaders of the other functions. So that's how the finance function relates to other functions. Then what is included as a part of operation. So starting from material purchased from the buyers. I'm really sorry. Material purchased from the suppliers and providing them to the buyers. Every aspect of it is included into the concept of operation. So after material is purchased, that is moved to the stores department, moved to the production departments. The production is taken up. Produced products are moved to the showrooms, and then the sales happen. After sales also there is after sales services provided to the customers. So that is all what is a part of operation. So we understood about what are the characteristics. The four V's are volume, variety, variation, and visibility. Process design, designing how does it take place, and then a process map, which talks about step by step how they would be taking up the course of activities. Then the designing part, how does it happen? First, the requirements are taken, concept is screened, design process, then it is time to market that, and then we also test it. We have learned about Porter's value chain analysis model, where the activities are classified into two: primary activities and support activities. So primary activities start from inbound logistics operations, outbound logistics, marketing and sales, and services. Then support activities, we see the primary activities can be carried on. They can be taken up with the help of support activities like infrastructure, human resource management, technology, and procurement. What is the interface? The interface is the connection, the link between these two functions. The interface is when purchasing depends on the finance function to seek advice on what price can be paid to the supplier. Production also gets connected to the finance function um, in terms of understanding what is the cost cost control measures and the quality aspect of it. So when there are efforts put in to cut down on the cost, there should be no compromise on the quality. So able to understand what are the aspects which have to be taken into consideration in terms of how much cost should be controlled and what quality standards should be maintained. Service provision. So it works out with the finance function in terms of establishing the charge out rates. Then what is the meaning of supply chain? A sequence of activities starting from the material acquired from the supplier till the products are delivered to the customers. So every activity which is there in between this is part of supply chain management. Supply chain management. Supply chain consists of a network of organizations. Together, they provide and process the necessary raw material first into work in progress and then into finished goods and sale and distribution to the end customers. So, everything a sequence of activities starting from supplier to customer. So, then how that is supply chain, and managing the supply chain, every aspect of the supply chain is supply chain management, involves the coordination of activities from the suppliers of raw material at one end and the supply chain to the customers at the other end. So what are we going to look into this is how the relationship with the supply chain can be managed. What's the interface between supply chain management and the finance function? There is a model which is given by Cousins strategic supply wheel. Wheel has a center part which is also called as the hub. To the hub, all the other spokes are connected so that the wheel can move effectively. So that is how we can see the imagine the wheel to be. So the supply chain part of it is connected. Cousins strategic supply wheel depicts the corporate supply strategy at the hub of the wheel. This is the strategy and underlines the need for an integrated approach. At the center of the wheel, there is a corporate and supply strategy. Then other spokes are connected to the hub. Like the wheel is there, and then in the middle there is a hub, and all the other spokes are connected. So also the model given by Cousins talks about depicts the corporate supply strategy at the hub and the wheels and underlines the need for an integrated approach. It talks about having a interconnected, integrated approach to supply strategy involving a balancing of all spokes of the wheel. But what are there in the spokes of the wheel? We see that the organization structure. What is the structure of the organization? The relationships which are present in the organization, the cost benefit analysis about how the supply chain management is managed, what is the cost incurred, what is the benefit which is derived. Then we see what are the competencies of the organization and how the performance is measured. So all of them should be connected to the corporate and supply strategy. So they have to achieve the organization objective. So The supply strategy also has to be connected to all the other aspects, the organization structure, relationships, cost benefit analysis of the organization, competencies and performance measures. So um, depicts the corporate supply strategy at the hub of the wheel and underlines the need for an integrated approach to supply strategy. So that involving a balancing of all spokes of the wheel. Relationships with suppliers are an important aspect of the wheel. We see that past approach was contractual relationship. Now the modern approach is collaborative approach. So they are collaborating. Earlier it was um, it was like entering into a contract and maintaining a relationship. Now on a collaborative note, so together they take the decisions, and then with a collaborative approach the relationship is maintained with the supplier. In connection to suppliers, purchasing, production, etc., we have various systems present. That is, the first one is material requirement planning. Systems available to ensure materials are ready when needed. Um, See, the customers would approach for the product in future. So before the approach, the required arrangements have to be made, like material has to be purchased, then the production is taken up, the finished goods are moved to the showroom so that the customers are provided with the finished product. So they cannot wait until the customers approach, because the production process is a time taking process. um, for that reason, and the material is purchased, and also the production process is a continuous process, so constantly there is always a requirement of material. So how do they take up the planning? We call this to be as MRP, material requirement planning. What does it mean? See, when would they require the material to be purchased? A computerized system for planning requirements for raw material, work in progress, and finished goods. Let's say that the future there would be a demand. So what do they do is they enter these details into the system and specifically convert all of them into dates. In if we say in future, instead of being very general about the future, convert that into specific dates. So as on during this particular week of that month, this would be the demand. So if that is the demand, to cater to that demand, when should they finish the production? So the it would be backwards. They keep planning in a backward sense. So to meet the demand during that particular period, by when should they keep the finished products ready? When should they finish the production? So the date also will be it is looked back and the dates are decided. So when should the production be ready? So to take up the production, what are the resources which are required, and when would they purchase that? Material requirement planning. So planning about when the material should be purchased. So they cannot wait until the demand arises, because it is basically a time consuming process. So on that note, they cannot wait until that, but um, take it up beforehand and then keep it ready available to the customers. So the material requirement planning talks about planning to purchase the material so that they are ready or equipped with the finished product to be supplied to the customers on a future date. That is about material requirement planning. Next, we see manufacturing resource planning. That is an extension of MRP and includes, for example, what's the production planning, demand forecasting, and productivity tracking. The material requirement planning is only about the purchase of material. Manufacturing resource planning also goes ahead and then plans about what is the production, etc. So other things are also planned, and there is a track of what is going on, of how much is the demand forecasted. So according to the demand, how many units should be produced, and to produce that, the purchasing part of, so everything included into that is about manufacturing resource planning. Then we see another planning system called as enterprise resource planning system, ERP. There is a key point about ERP. What we have to remember is the ERP, um, it integrates all other details here. The next evolution of MRP is integrating information from operations with that from other functions into a single system. A system which integrates all other systems is called as enterprise resource planning system. We will see what are quality related costs, but before that, let's have, in a short while we'll go back and then see, there are few techniques which can be used to improve supply chain management. So what are those techniques? The first one is statistical process control, then total quality management, Kaizen, Six Sigma, lean thinking, just in time, reverse logistics. So the first one, statistical process control. So what is done in that? A method of measuring and controlling quality during a process. So that's about the um, statistical process control. They ensure that quality products are produced. So measuring and controlling quality during a process. Okay, then we see the next accounting systems, the cost accounting system. The first one is TQM, Kaizen, then Six Sigma, other things are all focus on, especially TQM and Kaizen, they both focus on continuous improvement. Both of them work towards continuous improvement. They both focus on continuous improvement. So continuous improvement, how do we differentiate? What is that? See, continuous improvement talks about every effort which is made to improve their performance better than the previous one. So that is continuous improvement. So constant effort to improve themselves. um, but how are these two different? So TQM focuses on um, ensuring quality products are produced. So there is no defective unit which is produced. That is their focus. So the continuous improvement in quality, productivity, and effectiveness is the focus area about TQM. So TQM talks about quality products being produced without any defective unit being included in the production. But Kaizen's continuous improvement is about cutting down on the cost. So they also talk about continuous improvement step by step, but their focus is little different. So first, let's figure it out about TQM. So TQM effort is to improve their performance step by step or on a continuous basis, but with the focus area on no defective quality products which are produced. So in that context, we have a concept called as what are quality related costs. What are quality related costs? See, to these costs are incurred to ensure that quality production is taken up. So there are four different types of cost, broadly categorized as conformance cost and non-conformance cost. First category, under that first two costs are prevention, appraisal. The next two are called as internal failure and external failure. What is prevention cost? Prevention cost is as the work is being carried on. See, even before the work is being carried on, if even before the work starts, there are certain measures which are taken up to ensure that no defective production is taken up. Like right at the time of designing, only they design the products or processes in such a way that no defective product is being produced. The designing of the process is such a way that some training is, whenever it is required, it is provided to the employees so that they can be involved in identifying defective units or producing non-defective units. Then appraisal. So even otherwise about the preventive units also, there can be still, even if they take preventive measures also, still there could be a possibility of a defective unit being produced. So appraisal as the work is being carried on. So during the process of carrying out with the work, they can check the units which are produced, so randomly check some of them. So they take up inspection and product testing. So this is as the process is being carried out. So prevention costs. So preventive measures are taken to ensure that quality products are produced. Then we see appraisal, that is during the process some um, testing and inspections are taken up to randomly check whether they are quality products or not. In spite of all this also, the final unit which is produced out of the lot of units, um, one or few units could be defective. The final product is produced, they are defective, but the only best part is that they are still not delivered to the customers. So as they are still in the factory premises only, they are identified that the final finished products which are produced are defective. So what is done, they would spend some reworking costs, spend some costs, so that these defective units can be reworked and they can be sold in the market. So internal failure cost. Why are we calling it as internal failure? Is because it is a defective one, it is a failure, but the it has not yet reached to the customer, so it is internal failure. Then when the product produced is a defective one, it is already delivered to the customer. In that case, what how can they manage that? So external failure is when the product is produced is defective and it is delivered to the customer, and now to compensate for that defective unit, the business will take up um, measures like provide them services free of cost, maintain that maintenance costs are incurred. See, they incur that, but they do not collect anything from the customer because that might be during that warranty guarantee period. So during that period they are obliged to, or they are supposed to take up those activities. So on that note, it is a failure, it has reached the customer, so it is an external failure. So internal failure and external failure, these are four different types of quality related costs to ensure that quality products are being produced. Fine. So TQM's focus is on quality, no defective units. Kaizen is a Japanese concept about continuous improvement. They believe in cost control, and they take the feedback to improve themselves. They take the feedback from internal resources like employees. They take the feedback and then implement that as to how they can cut down on the cost reduction. Then we see Six Sigma. Six Sigma is you have learned normal costing in your BA2 paper, I think. Normal distribution is a probability distribution. So as a part of the probability distribution, we study that the probability of a particular event can be calculated, and with the help of a normal distribution curve. Now, the features of this is the curve is at its peak when it is at its mean. So where mean is equal to median is equal to mode, that position we see that the peak is at its peak, and it is symmetrical in nature. Both the sides they are equal. The curve takes the bend when it is mean x bar plus 1 standard deviation, x bar plus 2 standard deviation, x bar plus 3 standard deviation is the area which is majorly covered, which is to the extent of 97 point some percentage of the area is covered when it is x bar plus 3 standard deviation. The curve doesn't touch the x-axis, it extends from minus infinity to plus infinity, but covering the major acceptable region to the extent that on both the sides it is x bar plus or minus 3 standard deviation. So that is the area which is covered by 97 point something. So now Six Sigma concept says that the acceptable region is within x bar plus 3 sigma, but um, not allowing any defective unit being included. So they extend it until it is x bar plus 6 sigma. So a major portion of that acceptable region would be 99.9999% something is considered to be as the accepted. So it would be accepted as a defective free unit when it falls within that. So a very minute possibility that there would be a defective unit being produced. So aims to achieve a reduction in the number of faults that go beyond an accepted tolerance level. So it's 3.4 defects in every 1 million. For every 1 million units, the number of defects which happen would be only to the extent of 3.4 defects. Okay. That is the concept of about Six Sigma. Then we have lean thinking. What is lean thinking? To some extent we see lean thinking and JIT to some extent they talk about the same thing, but with of course there are certain principal differences between lean thinking and JIT. uh, we are discussing about the supply chain management. Now in the supply chain management, in the conventional method, what we understand is the first step is to purchase material. Material is purchased, see, not even knowing what whether the customers would come for purchasing the products or not. The conventional method of it, first purchases the material from the supplier, they are moved to the production department, production is taken up. After the products are produced, then they are moved to the stores or showrooms, and the products are kept available for the customer to come and purchase. So what do JIT and lean thinking talk about is not take up this regular procedure, the conventional method of purchasing all that, because there are additional cost included. So instead of that, take up the work right at that time, take it up. So what additional cost would be incurred? See, when material is purchased, CBC, there is an operating cycle. The operating cycle talks about cash is invested in material, that is raw material is purchased, raw material gets converted into work in progress, then it is converted into finished goods. So we see that finished goods are produced. Then finished goods, when they are produced, they are moved to the showrooms, then sales happen, and based on the credit policy, if credit sales happen, at the end of the credit period, the customers pay the amount. So there is a whole cycle which goes on from the time cash is invested till the time the cash is recovered back. It is converted back into cash. So this is a cycle called as operating cycle. So during this operating cycle, as long as this period is, because Instantly raw material will not be converted into finished goods. It is a time taking process. And then also we see that the credit sales at the end of the credit period, let's say they might have given a 1 month 2 months period of credit time. So at the end of that period only cash will be paid back by the customers to the business. So now in this context, as long as this period goes on, there are costs incurred. That is, when they purchase raw material has to be stored, finished goods also have to be stored till they are sold. So storage costs have to be incurred. That is one thing. Important then this one is, how do they get the cash? Cash is taken from um, the funds which are raised. Cash is available when only when funds are raised. Funds are raised from loans, debt capital, equity capital. There are various sources from which the funds are raised. When the funds are raised, on the funds, cost of capital is paid. So now cash is blocked in all these things. So during that lengthy period, that long period, they would be paying cost of capital on the funds. So there is cost of capital plus storage costs which have to be paid to store the inventory in all forms. This is the conventional method of taking up this activity. The operating cycle in the conventional method goes on like this. So there are costs of capital and storage. So now just in time and lean system say that instead of spending these costs, so take up the activities only when it is needed. Take it up only when it is needed. Um, so what is the suggestion? So lean thinking says that aims to systematically eliminate waste through the identification and elimination of all non-value adding activities. So the concept says that the right thing at the right time should be taken up. Right thing at the right time should be taken up. Um, is the concept of lean thinking, but there are certain other principles also which support lean thinking, like they should be systemizing their activity, systemize, structureize, sanitize, standardize, um, and self-discipline. These are the principles on lean thinking. But just in time also believes that right at that time only things have to be taken up. So what are they focusing on? See, we see that the conventional method of purchasing is, there is a supplier. First, the business approaches the supplier. Business approaches the supplier. Then the supplier delivers the material to the business. The material is moved to the organization purchases the material, and the material is moved to the stores. It comes to the stores department, and from the stores department it moves to the production department. From the production department the finished goods are again moved to the showrooms or the customers. So that is the cycle which takes place. JIT says, do not buy anything and do not produce anything beforehand, but rather wait until an order is placed by the customer. So they wait till the customer places an order. So to fulfill that order, when the order is received from the customer, to fulfill that order, the production will be taken up. But did they make any arrangements beforehand? No, they have not made any arrangements in terms of the material purchase. Nothing is done beforehand. Right at the time after an order is received from the customer, then to fulfill the order, the production will be taken up. But there is no material. So to take up the production, now they go on purchasing the material. So the purchase of material takes place right at that time, just at that time. So purchase the material, and to purchase the material, they have to approach the supplier. So immediately buy the material from supplier and then deliver the order to the customer. So it looks simple, but there is a lot of background which goes behind that. So in the last classes also we've discussed that purchasing of material from the supplier is a time taking process. It consumes time because orders have to be quotations have to be placed, then based on the quotations orders are placed, supplier delivers the material, quality is checked, etc. So to solve this issue, what is done is all the terms and conditions with the supplier about the quantity, quality, price aspects of it are all pre-decided. They are decided, they agree with the supplier, and the supplier also happens to be a reliable supplier. So whenever they require the material at that time, right at that time, the material is supplied by the supplier to the business, right at that time, just in time, just at that time, the supplier supplies the material when they want to purchase. But of course, he will stick to the quality standards, etc. Then once the material is purchased, they take up the production. But production activity is also kind of a complex activity only. There is a requirement of multiple skills which are needed. So taking up all those skills, various different types of workers working together, and then the production happens. Now there is an urgency. The order has to be immediately delivered to the customer. So all measures are taken in such a way that there would be no disturbance in the production. That is, the entire production activity is considered to be, the workspace is considered to be as one single unit or a cell, work cell. In that, all the workers are aware of what is the work of other workers. So everybody understands every type of work. Everybody can be easily replaced by the others. So on account of absenteeism, there would be no disturbance in the work process. So if one person is not present also, others can easily replace him. The layout is arranged in such a way that it takes less time for the material to move from one place to another place. Then every employee, the worker in the organization also understands how to operate all the machines, etc. So there would be no delay in terms of production, and then quickly they can complete the production and deliver the order to the customers. So the whole system is called a just-in-time system. Everything is taken up just at the right time. Of course, it is a risky thing when there is a breakdown at any level. The whole thing would be a flop. That is, they would not be able to fulfill the order placed by the customer. So that is a risky thing, because once the customer is lost, he may not come back. So that danger is always present. Okay, but ensuring that they do not uh, block their capital or block their cash in this operating activity, so they don't have to pay storage cost and cost of capital. To eliminate those costs, unnecessary uh, non-value adding activities, unnecessary cost which can be eliminated, JIT suggests that take up the production only when the order is received, and to fulfill the production, purchase the material from a reliable supplier, and then deliver the products at that time. So now cash is not blocked in anything. Immediately it is all completed. So they don't have to store this material, because they, as soon as they buy, they convert that into finished goods and then sell it. So no storage costs are also needed. Because that is just-in-time system, which talks about procuring inventory and produces products as they are required by the customer for use rather than for inventory. So there's no storing of anything as inventory in the business. So that is about the just-in-time system. Lean thinking also says that do not take up anything beforehand, but right at the time when it is needed, take it up. Don't invest anything in non-value added activities, but invest in those activities which are needed at that point of time. Then the last one is reverse logistics. The reverse logistics talk about the return of unwanted or surplus goods back to the organization for reuse, recycling, or disposal. So that is reverse logistics. So return of unwanted surplus goods back to the organization so that they can be reused or recycled or something, or disposed if it is not any of any use, it is not useful. Okay, so that's called as reverse logistics. So these are the following techniques that can be used to improve supply chain management. So we are discussing the topic about how the finance function interacts with the supply chain. I mean, not supply chain, operations at large, operations. Then it is important to understand the interface between SCM, supply chain management, and finance. Interface, how the finance would interact or link with the supply chain management. So a collaborative relationship between the CFO and the leader of supply chain. So together they would take up the work. So collaboration between the chief financial officer and the leader of the supply chain management, supply chain function is advantageous for organizational growth and competitive advantage. The finance function has a unique end-to-end view of the organization and is considered a trusted advisor. So they can help them with their advisors. So as a result, there are a number of opportunities for finance to enhance performance through business partnering by advising, by guiding, by providing their partnership and advices to the supply chain management. Examples include establishment of appropriate KPIs. So the next topic is about the KPIs. So every particular every particular function where the finance interacts with, we are going to discuss about what are KPIs. What are KPIs? Key performance indicators. So it says include the establishment of KPIs, appropriate KPIs, or helping with the financial side of supplier relationships. Technology has been an important enabler in business partnering. So, but now let's come to that point about what are KPIs. See, in an organization, when the performance has to be measured, I'll erase both the sides, whatever scribbling is there. See, when the performance has to be measured, let's say that how do we understand whether the organization is performing well or not? So that sorry about that. What are we discussing? KPI. So when the performance has to be measured, how do they measure the performance? Can we say that the organization is doing well just like that? There should be some way, some certain parameters should be there so that we can use that and talk about it. See, whether or not you have learned the subject well, how do we understand? Only when you score marks in the examination. So then how do you perform in various other activities in the college, etc. So it talks about your performance as a student in the organization, in the college, right? So also whether the organization is doing well or not, then it has to be understood. Certain parameters, certain factors have to be identified. They are the vital important factors which can ensure them success. Success in terms of whether the objectives of the organization are achieved. So we call them as CSFs. CSFs or critical success factors, those which are important ones to ensure that when these factors perform well, it it would be about the achievement of the organization objectives. So that is the point what uh, CSFs talk about. CSFs are the vital important factors of the organization whose performance can assure them about the achievement of the organization objectives. Mere identifying CSFs is not sufficient. So then CSFs, when they are identified, they have to be measured. For example, see, for example, if we are talking about CSFs, if we say that sales is an important CSF, if sales is defined as one or identified as one CSF, um, sales can be one thing, customer satisfaction can be one thing, quality production can be one thing, things like that. Various factors have to be identified. After the factors are identified, the measurement has to be taken place. The measurement is taken up with the help of KPIs, key performance indicators. We have to measure. Just because we say that sales is an important factor, that is not sufficient. Then again, whether sales is performing well or not has to be measured. So maybe in terms of whether there is growth in sales has to be looked into, growth or increase in sales. So if it is continuously increasing over each period, then we see that there is growth in sales. If sales do well, that will result in profit, more profit, then profit maximization, then the objectives can be achieved like that. There are many CSS which help them understand the performance in that particular aspect. Then we can see customer, if they are satisfied, customer satisfaction. How do we measure customer satisfaction? By taking up a feedback from the customer. Then we can talk about whether quality is included. So then quality check about whether zero defective units are produced or not. So every aspect of it has to be measured. Measurement is by way of key performance indicators. So now we are doing about the topic where the finance function is interacting with the operations. So in under operations, very specifically about the supply chain management. So what are KPIs under supply chain management? So first, before we talk about KPIs, we should first define what are the CSFs. Once the CSFs are defined, identified, these CSFs should perform well so that the measurement can be taken place. That is, key performance indicators um, are the measures that indicate whether or not the CSFs are being achieved. Characteristics of good KPIs include, what are they? The cascade from strategy to tactics to operational level. There are three different levels in the organization. We have already discussed so many times, that is strategic level, tactical level, and then operational level. So cascading from all these levels, then cover all perspectives of operation. So everything related to operation. So can we define what could be the CSFs? The CSFs under operations will be about the quality, the productivity, the efficiency, customization according to the customers, taking up the customized production. These things could be CSFs. Then how do we measure? If we are talking about quality, we talk about zero defective. If we talk about flexibility, then we talk about whether delivery according to the customers is taken up, or customization requirements according to the customers expectation are taken up, um, to ensure that the productive place is a safe place to work. So how many accidents are there, or no accidents are there, that has to be measured. In case if accidents happen, then um, how do we how does the business react to that? That is there any insurance claim? So like that, everything related to the operations has to be looked into. So first define all the CSFs, and after defining the CSFs, each CSF has to be measured in terms of understanding whether they are performing well or not. So key performance indicators are the measures that indicate whether or not CSFs are being achieved. KPIs should have certain attributes. What are these attributes is they should be smart. When we talk about what are KPIs, KPIs should be smart. So what does this is an acronym. SMART is an acronym. What does SMART stand for? It says S is specific, M is measurable, um, attainable. A is attainable. It is possible to achieve that, attainable. R is relevant and T is timeliness. So it should have these qualities, these attributes. KPI should have that. That is, they should be addressing it specifically, specific. Then once the KPI is decided, it should be measurable. They should be able to measure it. Achievable. It cannot be very ambitious. It should be possible to be achieved, achievable, relevant to that particular business or industry, the KPI. Then T is timeliness. Whenever it is required within that time frame, it has to be provided. So timeliness. So KPI should be smart. Then we see align to employees reward system. After the measurement is there, performance is evaluated, the performance is measured with the help of KPIs. So performance measurement should result in uh, appraising the performance of the employee. That is, they should be given certain rewards based on performance. So that should be connected to a reward system. Then it also is extended to supply chain partners. So it also should be considering the supply chain partners. Few examples of KPIs for operations are given. Supply chain cost per unit sold, time taken to deliver a customer order, percentage of on-time delivery to a customer, percentage of customer orders fulfilled, percentage of defect rates, percentage of wastage rate. So these are all involved with the operations activities, the activities which are covered under operations. So sorry about that disturbance. Sorry. Um, so these are the KPIs in operations. See, finance function activity, how the finance function helps manage operations through the use of KPIs. So that's the next topic. With the help of KPIs, how the operations can be effectively managed. That's the next topic. So what are the we already understood about the finance function, the framework. It starts from assembling of information, analyzing that so that insights can be drawn, and with the insights, advices can be given so that there is an influence. Ultimately, see that there is an impact. That is the framework. We've already learned that. So at every step of this, every stage of this finance function framework, how the finance function helps manage operations through the use of KPIs. That's the next topic. So works with operations to set appropriate KPIs. First one is identify or set the appropriate KPIs. Who works? The finance people in the finance department, the CFO, the leaders of the finance department interact with the leaders of the operations department, and then they work with operations to set appropriate KPIs. What is the use of KPIs? KPIs measure the performance of CSS. Just so they work with the operations to set appropriate KPIs, then assemble data and processes into useful KPI information. So the first part of it is assembling of information. So they assemble data which with which they can process them into useful KPI information. Then reports information to those people who need it. This data which is collected has to be analyzed. So analyzes KPI information to draw out patterns and relevant insights with those for those who use the information. The questioning may require the individual KPIs to be broken down. Advising and influence. So communicating the insights and then um, developing solutions so that finally these solutions can be deployed. That is applying for having an impact. So these steps of finance function, how they help the operation. So understand about what KPIs, what is the way in which they can measure the performance, etc. That all will be taken up. So with that, we come to the end of how the finance function interacts with operations. Now, what is left? We have how the finance function interacts with sales and marketing. So extensively, we are going to look into what is sales and marketing, various aspects of sales and marketing, all that will be taken up. Then after the interaction between that, and then finally we end with the KPIs in under sales and marketing. Then the final, no. Then we have human resources function. Then finally the IT function. I cannot do MCQs now because see all this they're not there in order randomly anything about interacting with the other functions of the organization can come up. So unless and until I finish all the topics, I will not be able to touch the last section of MCQs. So we'll continue with this. um no, this is not the one. How the finance function interacts with sales and marketing. So that is the topic, the next topic. So let's take it up. What do we learn in that? We first basically have to understand about what is the meaning of sales and marketing, understand the marketing mix, the main techniques of marketing, how the finance function interacts with marketing, and then the final thing is KPIs. So the introduction of sales and marketing. What is marketing? There is a definition which is given by marketing by Chartered Institute of Marketing. Marketing is defined as the management process that identifies, anticipates, and supplies customer needs efficiently and profitably. Taking up those activities, that is, identifies, anticipates, and supplies the customer's needs in an efficient and profitable manner. That is marketing. What is that process? The first step in this process includes what is the pestle analysis. Pestle analysis is about um, first the pestle analysis is trying to understand about the pestle stands for P is political, economical, social, technological, environmental, and legal. So these are the six things which are first looked into. Whether there is political stability in the economy, uh, what aspects of the political scenario exists in that particular economy, everything related to the political environment is first studied. So whichever economy they are looking into, for where the marketing activities have to be taken up, so the political scenario has to be studied. E is economical. Economical is about the economy. So economy we can understand about the trade cycles, the inflation, the price index. Then in the economy, what is the GDP, the growth rate? Those aspects are uh, studied under economical. Economical. So anything which is prevailing in the economy about the various aspects like GDP, growth rate, growth in the income, then inflation, recession, anything which is prevailing in that particular economy at that point of time when the marketing activity has to be taken up. Social talks about the people. The social aspects are the cultural preferences, the practices of the people, the percentage of male female, that male female sex ratio, then what are the tastes preferences, those things are taken into consideration. So everything to do with the people, their culture, their habits, their preferences, the way in which the people are composed in the total population. So that aspect is considered under social. Technological, technology wise, what is their stand, what is their position, how advanced they are, what I mean, is it in the growing phase, or technologically they are quite advanced? So everything, every aspect about the technology is studied under technological. Second E is about environmental. So if, let's say that the organization, the way in which the activities are carried on has an impact on the environment. If there is an impact on the environment, there are certain rules and regulations which are laid out for the organization. Now we have to understand that what is what are the rules and regulations, whether the organization is complying with the rules and regulations, the percentage of pollution which the organization creates, carbon footprints, all these aspects are covered under environmental. Legal is about the law, the legislation, the law, or the rules or which are levied for them, which they have to follow. So that is about the legal. Pestal, political, economical, social, technological, environmental, and legal. All these aspects have to be first analyzed. So before they take up the marketing, so they have to have a thorough understanding about what is going on in the economy, every aspect of the economy. Next, they have to understand about what is the mission and the objective. So what is mission? Mission is the very basic purpose why the organization is set up. So mission defines the objective of the organization. So once the mission is decided, how would they achieve that? So what objectives would be? So the goals and objectives will be defined. Then they work out on achieving that by preparing the strategies, the plans, and all. The achievement will be taken place. So review the mission and the objectives of the organization. Then, in terms of very specifically related to marketing, what are the marketing objectives? So they have to be understood. What are the marketing objectives? Um, a device marketing strategy, that is in terms of research, segmentation, targeting, position, and marketing mix. We will be studying that now. Then after the strategy, after the marketing strategy or marketing plan about how they will take up the marketing activities. Once that is decided, they would go on to implement the plan. Whenever plan is decided, that plan has to be implemented. So at the time of implementation, they have to understand about how they are implementing it. Okay, implementation. Then review how they have, what have they planned and how are they implementing. So there should be a review which has to take place. So the market planning process starts with analyzing the various aspects of the economy, review the mission, then set the marketing objectives. Then based on the objectives, they have to decide what is the marketing plan, implement that plan, and then understand whether the plan is effectively implemented or not. Then as a part of the marketing, we have to understand what is the marketing mix. So a combination of various aspects. So traditionally it was conveyed as, or it was mentioned with the help of 4 P's of marketing mix. The first one is product, place, promotion, and price. Later on, another 3 P's also were added, which is people, process, and physical evidence. So product about what are the features of the product, durability, design, branding, packaging, range, after sales services, warranties, guarantees. So all these are a part of the product. So everything which is associated with the product, which describes the product, the other attributes of the product, are the first P, product. The second one is place. Okay, where would they sell these products? Sell directly to consumer or indirectly using intermediaries such as wholesalers and retailers. So the place where the sale of the product would take place. Third one, what promotional activities would they take up? That is, do they sell directly to the customers, or they take up certain promotional activities like advertising, personal selling, public relations, sales promotion, sponsorship, direct marketing, and certain other newer techniques also. So, what are the ways in which they would be promoting their products is promotional activity. Then, finally, the price of the product, price, price level. Consider 4 C's. Um, Pricing strategies. We were going to discuss in the coming slides. What are the pricing strategies? Pricing strategies: discounts, credit policy, payment terms. So what is the price? The price which has to be considered. So of course we have to discuss in detail about what are the pricing strategies. So I will explain that. What are the pricing strategies? The discount which is given in terms of price, the credit policy to sell the product on credit basis, um, the credit policy, the payment terms, all that is a part of the price. Later on, the other three P's include the people also are included in the part of marketing mix, the processes which are taken up, and the physical evidence, the evidence about the marketing activity which is taken up, physical evidence. Now, when we look into what is the pricing, what are the pricing strategies which are available? So we need to understand whether it is uniformly the same price offered to all the customers across all the regions or not. Now that has to be understood. We don't see that the same price is offered to all the customers all the time. One second, let's take what are the pricing strategies? The first one is the conventional method of deciding what is the selling price. So all of us understand what is selling price. Selling price is equal to cost price plus profit. That's the conventional way of deciding about the selling price. Okay, price based on cost plus a profit margin. Next, we have penetration pricing, skimming pricing. They are totally different to each other. So first one, to launch the product, if the business takes up the strategy of deciding or launching it at a lower price. So many customers get attracted. Once the customers get attracted, then they decide on the market. I mean, they are convinced of the market share that they have achieved the desired market share. Then they slowly or gradually, after a while, they gradually increase the selling price. That is penetration pricing, exploring the market, attracting new customers, getting into the market, exploring that uh, different markets, and then getting deep into the market is about the penetration pricing. Then we have the skim pricing, which is um, instead of launching it at a lower price, it is launched at a higher price. The reason why it is launched at a higher price is maybe the research and development costs are very high, and also um, it is anticipated that the um, life of the product would not last for a very long time. So most of the time we see that example with the electronic products, that initially when they are launched at a higher price. But after a while we see that drastically the price falls down. Especially with the mobile phones, we see that when the product is launched, we see that the product is launched at a higher price, and after a while, within, let's say, within few months only, we see that there is a decrease in the price of each model. What is the reason behind that? See, it is anticipated that these products do not last for a very long time because of the advancement of the technology. They would not be there in the market for a longer period of time. So as long as they are there in the market, so every unit which is sold should be able to recover the initial fixed cost or the research and development cost, whatever are required, that they are recovered. So that is the focus area. So to recover that, they charge the price at a higher price. So once these costs are, the fixed costs are all recovered, then they reduce the price. So that's where we see that the price drastically falls down, because the life is also not a very long time that they can keep on selling that. See, so these electronic products also, televisions is one example. We see gone were the days when television was just television, and before that also it was before that phase also it was either a black and white or a color television, not beyond that. So then television was a television for a very long time. Now television is, so many things have come. LED, LCD, whatnot. Those space is gone. Then OLED, now whatnot. There's so much of technology which is built into the televisions, then laptops, then we see mobile phones, electronic products. So the features are going on added. Therefore, that is reducing because of the technological advancement. That reduces the life of the product. So during the short life of that product, they should be able to recover all their fixed cost. So with that focus, they launch the product at a higher price. That is called as skimming, price skimming, skimming price. Next one is perceived quality. Perceived quality is some of the customers perceive that if the price is high, it would be of a greater value, higher value. So that is a perception. So because the customers, a group of customers perceive it to be like that, the price is also set high. So perceived quality, high price to reinforce high quality image. It is the perception of the customers. You also must have come across. Some of them believe that if the price is high, the quality also would be superior. Sometimes we see that, not always, but sometimes we see that the same product is available in a ordinary shop at a lower price, and in a supermarket or a mall at a higher price. The quality would not be different, but because of the place where it is being sold, that could be a different. And then the customers also perceive that the ones which are sold at some specific slots or specific places are of superior quality. So uh, catering to that aspect or that image of that um, quality, the products are also priced accordingly. So perceived quality. Price discrimination. uh, the same product is offered um, to different in different regions at different prices. So you must have read that on products that in these two states this is the price, and the rest of the India this is the price. Sometimes you must have also have come across that could be because of the local tax differences. Then that local that state taxes are different. Best example is petrol is not uniformly the same all through the country. We have different prices in different parts of the state, because of those local taxes also being added. Liquor is another example. See, it is not uniformly the same price all through the country. So different, the same product, but different regions, different segments, it is different price. Price discrimination. Going rate pricing is, see, the conventional pricing is selling price is equal to cost price plus profit. Going price is, instead of deciding this way, they take first the selling price from the market. Why? Because the competition is severe. So the selling price would be taken from the market. After they take the price from the market, then they work it backwards. That is, um, for then they decide what is the profit margin. Every company would have, every business would have want have to earn a profit margin, so deduct that profit margin. Then we have what is the cost price. So then they ensure that their cost is within this limit. This is called as target cost. So that is going rate pricing, where the price is taken from the market. They do not first incur cost and decide the selling price. They first start with deciding the selling price, decide the selling price based on whatever is the price prevailing in the market, take that price, deduct the profit margin, and arrive at the cost price. Next, dynamic pricing. Dynamic pricing is price is altered in line with the demand. When the demand changes, according to the changes in the demand, price also changes. That is, in certain cases we see that now the law of demand says that when the price rises, the demand falls. When the, and vice versa. Then there is a inverse relationship with the demand and price. So exceptions to that also are there. That is, in certain rare commodities, precious metals, or stock exchange, those things, we see that they are exception to the law of demand. That is, when the demand rises, they rise the price also because the customers want it. So, vaccine prices, now that is the controversy which was going on. So state governments, all of them wanted, then the price immediately, of course now the central government is offering all those things, but initially in between we saw that when the state governments were under a great I mean, they were putting in great pressure and rush, then the price to the state governments was at a higher price. um, like that, when we see that the demand rises, according to the rise in the demand, the price is also altered, that is increased. Okay, dynamic pricing. Loss leaders are products are sold at a loss with the expectation that other products would be bought. So when they are together as a combination, when they are sold, so one product is sold at a loss to ensure that uh, along with this product, if some other product is also is also sold, so that can earn profit, and that will be sufficient. So they also go to the extent that one product can be sold at a loss with an expectation that the other would be sold. Captive product is for products bought together. The first is cheap, the second is expensive. um, Referral codes and all, you must have experienced that. See, first time offer, referral code, first time customer, we see that offers. So when, because the customer is purchasing for the first time, so there is a discount given, so it's at a cheaper price, then they eventually the later on ones which are purchased are at an expensive price. That's captive pricing. Okay, shall we end here in today's class? Nobody is listening to me.
Yes, ma'am.
Okay, Monday, max by Tuesday the syllabus will be done. Okay, Monday we will finish that, and then few MCQs we will work it out on Monday, and Tuesday would be the last class. In any case, Tuesday would be the last class. Fine.